Hi everyone. Now let's talk about the floor system in the ample reserves environment. Simply put, the primary monetary policy tool is no longer open market operations. What happened? The changes were made between 2007 to 2009 financial crisis in the United States. Before 2008, things were as we learned long time ago. In principles, the supply of reserves were scarce, and the Federal Reserve was it was able to control interest rates by open market operations. It was called the corridor system, as we learned previously. However, after 2008, during the response to the financial crisis, the supply of reserves became plentiful. So we say it's ample reserves and the environment. Then the old primary tools like open market operations no longer worked. Banks were accumulating huge quantities of reserves as well as non-financial firms. So the response of the Federal Reserve System to such reserves market was creating administered interest rates. What we are going to learn, interest on reserve balances and overnight reverse repo rates. As for the floor interest rate in the reserves market or federal funds market. So when we talked about the scarce reserve system, we talked about the open market operations can change the intersection of demand and supply. Can you see this? So demand and supply like this. And when the Federal Reserve System purchases the treasuries from the banking system, the supply of cash as the banking system, for the banking system, the supply of reserves increases by open market purchases by the Federal Reserve. And if there is open market sales by the Federal Reserve System, then supply will decrease, supply of reserves will decrease. So in that way, supply of reserves was controlled. But that was when the intersection was made in the downward sloping section of demand. That is scarce reserves environment. Now, when the supply of reserves are ample and plentiful, then supply of reserves is already far, far away from the downward sloping section of the demand curve. So if we try to find the intersection of them, then the intersection is below zero. The intersection gives us negative federal funds rate, which is not realistic. That cannot be the case. So this is called the ample reserves environment. And in order to make the federal funds rate positive, the federal funds of Federal Reserve System started to grant some positive interest on reserve balances by banks. So let's suppose there is this banking system and the Federal Reserve System. As we discussed, the reserves or cash holdings of a private bank like JP Morgan Chase, that is liability of the Fed. Basically, Fed borrows money from JP Morgan Chase, or we can put in other way, JP Morgan Chase deposit their cash holdings to the Federal Reserve System. Since JP Morgan Chase deposited money to the Federal Reserve System, Federal Reserve System can give interest under this interest on reserve balances idea. So let's say the interest on reserve balances is 5% per year annually. Then JP Morgan Chase will earn 5 million for 100 million reserves. So that is positive in assets for JP Morgan Chase. And now Federal Reserve System has bigger liabilities. 5 million more liabilities for JP Morgan Chase or the banking system in the US economy. This was necessary to keep the federal funds rate positive. Okay. So interest on reserve balances, also called IORB, I as in interest, O as in own, R as in reserve, B as in balances, IORB. That is the interest the Fed pays banks on their reserves. And it sets a floor on the interest rate banks are willing to lend it. So this creates a floor. So demand curve is downward sloping and it creates a floor there for the demand curve in the federal funds market. And on the vertical axis, we have federal funds rate, market determined interest rate, and horizontal axis is reserves. And now, with ample reserves supply is far, far away from this downward sloping section, but anyway, we have positive intersection with the floor. So federal funds rate will be determined at interest on reserve balances. All right. So suppose interest rate on reserve balances, IORB, is 5%. So if the Fed pays 5% risk-free, why would a JP Morgan Chase or any other private regular commercial bank lend to others for less? Right? So JP Morgan Chase, with huge excess reserves, is willing to lend Wells Fargo or other regular commercial bank if the overnight interest or the federal funds rate is higher than IORB. So suppose Wells Fargo is willing to pay 6% interest rate overnight, while IORB, the Fed, pays is 5%. Then JP Morgan Chase is willing to lend the money to Wells Fargo. But why would Wells Fargo pay 6%? They would not. So JP Morgan Chase does not lend to any banks, but hold excess reserve. If JP Morgan Chase does not lend money, then they will just deposit their reserves to the Federal Reserve System and earn interest on reserve balances. Also, suppose there is very generous bank. So if there were a bank which is willing to lend money to other financial institutions at 4% interest rate, then this is money generator, right? We have to run to the bank, borrow money at 4%, and deposit this money to the Federal Reserve System at IORB rate, which is 5%, then we can earn 1% per $1 million or billion or trillion, whatever you deposit to the Federal Reserve System. So this will also not happen because there will be infinite demand if the lending interest rate is lower than interest rate on reserve balances. So that's why we have the floor, right? This is not happening. The demand for reserve will be infinite if someone is lending at 4%. So that's why we have floor like this. So demand becomes infinite, goes far, far away at the floor. So demand curve is kinked at the floor interest rate, IORB, and the supply is already ample. It's already plentiful. So supply curve is right there and demand curve is kinked. Also, we have a ceiling for the supply curve. This is called discount rate. So let me just complete this picture. On the vertical axis, we have federal funds rate. Market determined the federal funds rate. On the right hand, on the horizontal axis, we have non-borrowed or reserves, just reserves. So what was discount rate, by the way? Discount rate was the ceiling of supply curve, and that is the interest rate at which the Federal Reserve is willing to lend funds against collateral to healthy, solvent banks. They are temporarily in trouble, so they cannot borrow money from other financial institutions. However, the Fed has some trust in this bank. Fed thinks that the trouble is only temporary, and if the Fed provides liquidity, then the bank can survive because the bank is basically healthy or solvent. So that's why the Fed is willing to lend, even though other banks refuse to lend to this bank. The loans taken by these troubled bank by the Fed from the Fed is referred to as discount loans or borrowings from the Fed or borrowed reserves from the Fed. Okay? Anyway, this discount rate is higher than other interest rate because the Fed is willing to provide liquidity, but against the collateral at a penalty interest rate. Okay, because they are in trouble anyway. They did something wrong. So because of this penalty, the discount rate is the ceiling of the supply curve. So Fed is willing to supply, but the Fed puts some penalty and the interest rate does not go higher. It is the upper limit. So that's the ceiling of the supply. And then as we discussed, the demand curve is downward sloping and kinked at the floor rate, interest rate on reserve balances. That was the floor. Okay. All right. Under this ample reserves environment, the floor rate determines the federal funds rate. Okay. So that floor rate is now the primary tool in monetary policy in the United States. So Fed, or actually the FOMC, Federal Open Market Committee, FOMC, sets the interest rate on reserve balances, IORB, along with the federal funds rate target range. Okay. Then the market determined federal funds rate is actually find the floor rate as the equilibrium because that's the floor rate. That's the floor rate. That's the intersection of demand and supply. Sorry, supply curve is kinked at the discount rate. Okay, so that was how the federal funds rate is determined under the ample reserves environment. Let me talk a little deeper. So we are going to talk about a market, which is called repo market. Repo is a nickname of repurchase agreement. This is kind of special financial contract. Let me talk about why this repo market is important. So there is this ongoing discussion of another change in monetary policy tools or policy policy target. So there are 12 regional bank, 12 regional Federal Reserve Bank across the United States, and there is Dallas Fed. Dallas Fed current president is Rory Rogan, and Rory Rogan president Rogan has repeatedly argued that FOMC should stop targeting the federal funds rate, but rather they should target a repo rate. So the Dallas Fed president thinks that the federal funds rate target is outdated because now the federal funds rate market itself is too small. Repo market is more broad, so FOMC should target the repo interest rate so that the FOMC's decision has more broader impact on the interest rate across the United States. So that's what she thinks about. And there are, this discussion is kind of ongoing. She put out the written argument this September, like 2 months ago, and the discussion is kind of rising to the surface right now. So we will see how it goes. And what's the repo or what's the repurchase agreement? So repo is a special financial contract. It's a short-term loan with collateral in the format of sell asset today, but buyback in the future, buyback tomorrow, actually. So in this example, I used collateral of my iPad. So imagine I sell my iPad Pro today, only $500. And I promised, and you also agreed to I buy it back tomorrow, giving you $30 additionally. So I will pay back $500 and I will give you $30 fee um, for our for showing my gratitude for you to agree um, to this kind of contract, to this kind of transaction. In this situation, I effectively borrow $500 from you with collateral of my iPad Pro at $30 interest per day. If I did not honor my promise, so if I just ignore my promise to buy it back tomorrow, then you have my iPad Pro. So you can sell it to the market, to anyone, and you can recover your $530 in total. All right. So this is the repurchase agreement between you and me. And the $30 is the repo interest rate. I'm sorry, repo interest payment. So again, repo is just a collateralized overnight loan disguised as a sale. Okay, collateralized overnight loan. This is collateralized short-term loan with with collateral. And actually, the Fed is utilizing the repo facility right now on top of the interest on reserve balances, IORB. So this is called overnight reverse repo facility. Um, Financial market people somehow like to use acronyms, and this is called overnight ON reverse repo facility. So ONRRP, that's acronym for overnight reverse repo facility. So some lenders in federal funds market are not eligible to earn interest on reserve balances, the IORB rate. That was not for everyone. And in that case, they are willing to lend their money at lower interest rate than IORB. The examples includes like here at the bottom, um, so money market funds or hedge funds or government-sponsored enterprises or agencies like Fannie Mae, Freddie Mac, and Federal Home Loan Banks. These agencies provide home mortgage loans or they trade something related home mortgage loans. So it is essential to support to these government-sponsored agencies for the Federal Reserve System. So the effective federal funds rate, in fact, have been lower than IORB rate because of these players, money market funds and Fannie Mae, Freddie Mac, and other government agencies, they are willing to lend money lower than IORB. So in order to stop their behavior and in order to create another floor, like double deck of floor, the Fed started to run this overnight reverse repo facility. So